We're looking at investment report today titled, It's Happening, SoFi stock to $38?
Right, the core of it seems to be that the super app idea is finally paying off.
Exactly. It's citing huge Q3 2025 numbers and some big catalysts to justify a 45% upside to that $38 high target.
And the writer really, makes a great case for momentum. That Rule of 40 score at 67. That's a standout metric.
It really is. It screams profitable growth.
It does, but that brings me to my first thought. If you want serious investors on board, you have to anticipate the pushback.
Okay.
So while the presentation of bullish catalysts is excellent, the overall narrative could be significantly strengthened by actively addressing the potential risk factors that a skeptical investor might raise.
You think it feels a bit one-sided?
A little, yeah. The weakness is that it's built entirely on this positive momentum. It sort of fails to reinforce that diversified financial powerhouse idea because it ignores volatility.
I see what you mean. But wouldn't adding a list of risks kind of, undercut the core bullish argument?
Not if you control the narrative. That's the key. So the suggestion is to add a brief section, maybe call it the caveats or something similar. And you use it to preemptively tackle those bear arguments. For example, you touch on the volatility from reintroducing crypto.
But then you pivot to how diversified their lending is.
Exactly. Or you manage expectations on the student loan privatization timeline. You turn potential weaknesses into, manageable variables.
That makes a lot of sense. It proves the thesis can handle some headwinds. So, okay, let's talk about that $38 price tag.
Right, because the report convinces us the company is high quality. That Rule of 40 score is amazing, but the target itself feels a bit unanchored.
Anchored only to analysts' opinions, you mean?
Precisely. So to transition the $38 goal from a high-end consensus target to a fundamental reality, the report needs a clearer, explicit valuation link derived from those outstanding Q3 metrics.
Okay, so a bridge. A bridge from the operating performance to the stock price.
Yes. The weakness is just leaning on the Wall Street consensus high. We need to show the math. We need to translate that incredible Rule of 40 score into a valuation. Right now it's implied, but it's not shown.
So how do we build that bridge? What's the actionable step?
I think you dedicate a short section to it. You translate that 67 Rule of 40 score into a comparable valuation multiple. Show how it justifies that 45% upside.
Like a peer comparison?
Yeah, for example. Use the score to establish a revenue or EBITDA multiple against other high-growth fintechs. You can then show how applying let's say, a slightly higher multiple, which is justified by these superior metrics, leads you directly into that $35 to $38 range.
I see. So it reinforces the idea that the analysts are
just catching up. They're chasing the price. But your analysis got there first based on fundamentals.
Okay, so this has been really helpful. 2 clear points. First, integrate a caveats section to handle skepticism head-on, which actually boosts credibility.
Right, and second, anchor that $38 price target with explicit valuation logic. Tie it directly to that fantastic Rule of 40 achievement.
Do that, and the whole thesis becomes much more robust.
I think so. Make those changes, and the persuasive power here will go way up.
We look forward to seeing the revision. Send it back to us when you're ready.